Consumer staple stocks are considered some of the safest stocks to invest in, but are they really good investments? Watch this video and find out. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. In today's video, this is kind of a bonus to my three-part series that I've done on consumer staple companies. I've been asked to cover a lot of different consumer staples by many of you, and I thought I'd go ahead and do a bonus video where I did a high-level overview of these companies. I'm not going to get into them in depth. I'm not going to recommend them. Generally speaking, I will show a couple that I think look attractive. I'm going to leave it up to you to do your own research on it, but these are companies that you requested. I'm going to ignore the General Mills, the Conagra, and the Kellogg that I did in the previous three videos. So let's start with a portfolio that I created in Fast Graphs of consumer staple stocks. This is the portfolio listed in order of ticker symbol. And I want you to notice as I click on the headings on these portfolios, you can create all kinds of different headings here when you go into the edit function. And that's for a different video. But what I've got here is I've got dividend yield, estimated earnings growth, estimated annualized rate of return, the current PE ratio, the earnings yield, price to EBITDA, EBITDA yield, the sector, the sub-industry, the credit rating, long-term debt to capital, and all of these have paid dividends for 21 consecutive years, except for Kraft Heinz, which was a recent spinoff. All right, so I'm going to look at this. Now, what are the advantages of using a portfolio review like this? If you put companies in here, if you like, for example, to run a screen and then convert it to a portfolio, then you can go in there and create the headings that you like to look at, and then you can organize those. Like here, I'm looking at dividend yield from lowest to highest. I click it again, I've got the highest to the lowest. I can look at valuation or things like earnings yield. As those of you who follow my work know that I like a 6.67% or higher. That's a 15 PE ratio. So you can look at either earnings yield or PE ratio, and you can see that, which ones have the PE ratio and or the earnings yield that meet the criteria that I, as Mr. Valuation, like to look at. So you can do a lot of, evaluating of a portfolio or a group of companies by using the portfolio function of Fast Graphs. But what I'm going to do is I'm going to go through these in alphabetical order, if you will, just, to make it simple to do. And I'm going to skip General Mills, Conagra, and Kellogg. So let's start with Colgate Palmolive here. That'll be the first one on my list. And what I want you to note here, I want you to notice some things about Colgate Palmolive. First of all, the company only grows at about 5.53%. It only has an earnings yield of 4.26%, but it does offer a reasonably attractive dividend of 2.64. It's AA rated, but it carries an enormous amount of debt. Okay, but what I want you to really notice here about this company is the premium valuation that the market applies. The blue line on this graph, we call it the normal PE. And what it is, it's a trimmed average of how the market has historically valued any stock that you're looking at in Fast Graphs. Now, the fair valuation reference line of 15 is what's considered, the correct valuation or the intrinsic valuation or the valuation that a stock ought to trade at, given the characteristics of 5.5% growth here. But the market puts a premium valuation on this high-quality premium stock. But I want you to, again, know how to use this. You're looking at a PE here of 22.28 over the long run. And clearly, when the stock is trading above that, it's trading at higher PEs. As you can see, Colgate has traded at higher PEs than its normal PE. So watch what happens if I shorten this time frame. And this is how you use this tool to analyze stocks. Watch what happens to the normal PE ratio here. It goes up to almost 26 over this period of time. And you can see how that 26 PE runs through the price. Obviously, most periods it was actually lower than that. So that's something that you want to be aware of. And what this really does, it allows you to assess risk. You can see that, Colgate is trading at higher valuations in recent years than it historically has. And that's even during a period of time here where the earnings growth was actually very poor. Now, we had low interest rates and a lot of things, that were going on that caused people to maybe chase this stock. But the point is, if you look at these high valuations and just use the calculator function and then run, calculations, you could have owned Colgate if you bought it on May 20th, 2016, and only earned 2.75%, including dividends, had a very slight profit, and most of your return came from dividend income by owning it. But you're also taking an enormous amount of risk here. Now, when I look at forecasting, the forecasting calculators, the 15 PE would indicate that you would have a annualized loss of about 7.1% over the next 2.5 years, or whatever you want to call that. And this does have a December fiscal year. If you look at the normal multiple, I want you to notice that's the high multiple. When you look at the normal multiple in a fast graph, it automatically defaults to the 5-year, the most recent normal. That's how the market's been trading for the last 5 years. They've been putting a 25 PE. So if I go here and run this at around the 7-year, you get that 25 multiple. I did 7 years because I included some forecasting here. And this is only looking at the historical multiple. Okay, but if I look at the long-term multiple, which I think is a more conservative way to do it, it's a 22 multiple, and this would give me a 9% rate of return if I invested in Colgate. If I invested in it and it went to a realistic 15 PE, I would lose 7%. But realistically, it's clear, understanding the market, that the market has always put a premium valuation. So if you're willing to accept that and willing to invest in the stock at those levels, now I've only been a buyer of Colgate around here. I want to be clear as Mr. Valuation. So I've been out of Colgate, but I don't think I've really missed a whole heck of a lot. If I bought this stock at these high valuations out here and owned it for all these years, I only would have made 3% a year. So it hasn't been such a hot investment over this time frame that I've measured here from May 23rd of 2014 to yesterday's close. It's had a lot of volatility, a lot of up and down. It has steadily increased its dividend, but including dividends, you only made 3% a year. So I don't know, how good of an investment it is. But I want you to be aware that one of the things that Fast Graphs is showing you here is that the market does put a premium valuation on this, and the premium valuation has even been higher in more recent years, and you're taking a lot of risk if you buy the stock today. Okay, so moving on, let's go into Campbell Soup. Campbell Soup now is a little bit different. It's only been growing at 3.5%. So, its long-term rate of return has not been real great. If you look at it from a standpoint of buying it and holding it, including dividends, and it does offer a 3.59% dividend yield. The blended PE is under 15. It does offer over a 7% earnings yield, which I like. It's BBB rated, has 53% debt. But you can see as a long-term investment, it's been stable as a company. Forget about the stock price. It's been stable as a company and stable as a dividend payer, but the price has been all over the place. Now it's becoming inexpensive based on, reverting to the mean and getting actually below. Obviously, the best times to be buying a stock like Campbell Soup or any stock, even if looking at it at the low valuation today, you'd have still made 6%. Valuation matters, and it matters a lot. Looking forward, the stock does offer a double-digit rate of return trading at a 15 PE, which, by the way, has been the conservative multiple in the case of Campbell Soup. The market has applied a higher multiple. So if you were measuring this going to the higher multiple, the normal multiple, and again, I'm going to revert this to the long-term normal multiple, not the most recent one, you could make 15.5% a year with a 3.5% dividend yield that's growing at a relatively, decent rate of maybe 4 or 5% a year. So Campbell Soup might be attractive to some of you right now. Moving on down the list here, we're going to skip General Mills. We go into Hormel. Once again, I want you to see this kind of befuddles me. This stock has traded at a high PE of 20 historically, but the more recent years, even if I run this as 9 years, it's been trading at something closer to more like a 24 PE and even much higher over times. And yet, once again, if I look at paying these high valuations for this stock, I would have actually lost money owning Hormel over the last 4 or 5 years. So is it a good investment at these levels? I personally don't think so. The forecasting graph says you would make a loss of almost 10% a year if it traded at a 15 multiple. And even if it traded at its very high recent multiple, you can make double digits. But if it traded at its long-term normal PE of 20, you would, have a very mediocre rate of return of just only 3% a year. I don't think now is the time to be buying Hormel, even though the price has corrected. The assessment of risk is what I want you to focus on. Hershey's is a real interesting one here because the market has applied we'll call it a 23 multiple historically. That's been the average. Now, it's been below that at times, above that at times. This is a valuation reference line. It got really highly valued, back in April or May of this year. It's now fallen dramatically into alignment, essentially, with its more normal PE or just above it. Okay, if I look at the forecasting graph, if I use the normal multiple, and again, I don't use the high one that's currently over the last 5 years, if I go to the normal PE of the last 20 years, this could give you a double-digit rate of return going forward. But once again, you are betting that the market is going to continue to give this A-rated blue chip with a 2.25% dividend yield, but only an earnings yield of 4.3%, a premium multiple going forward as it has in the past. I think you're taking a lot more risk than you should for less rate of return than you should, but realistically, the market has spoken, and it's always done that on Hershey's. If I go into Ingredion, which makes agricultural products, this is one of the more interesting stocks in this group. As you can see, it's been one of the faster growing at almost 11% a year. Looking forward, it's forecast to grow at 8.6%. Using a 15 multiple, it could give you a 22% rate of return. And using a conservative 14 or 13.7 multiple, it could still give you 18%. It's BBB rated, only has 33% debt, offers a 3% yield, a earnings yield of 8.48%, and you can buy it at a very low valuation with what I would call a margin of safety. And these have always been good times to buy Ingredion. So Ingredion might be one that you all might want to research a little deeper. Looking on at Kellogg, we covered that, so we're going to go to Kraft Heinz. And Kraft Heinz, was a spinoff from Mondelez, years ago. It came out at a very high valuation. I do want you to note that at these high valuations, and I'll do it from the highest valuation, this stock has been a very, very poor performer almost since it's been a public company. Even if I go to its, initial spinoff date and measure it till today, you would have made 4.15% owning this stock for all these years. However, if I look at it more recently, the growth has only been 1.5%. It's forecast to grow at 4% going forward, and using a 15 multiple can give you a 21% rate of return. Using a normal multiple of only 12.5 to 13 times, or 12.78 to be precise, it would still give you the opportunity to make a 14% rate of return with just under a 5% dividend yield, a blended PE of 11, and an earnings yield of 8.79. So this might be one, if you believe in the future, that the analysts are looking at. And let's look at it real quickly. There are quite a few analysts following this company, and they have been slightly raising the estimates over the last 3, 6, and 9 months. So, Kraft may be getting its mojo, so to speak. If I go on to look at Coca Cola, it's another premium valuation company trading at very high multiples in recent years. Same story, at a 15 multiple, it would be a loser if the market were to go there. At a normal multiple, once again, using the scroll bar here and going into its more normal 22 times earnings, it could eke out an 8 or 9% rate of return. So obviously it's a better buy today than it was, in April of 2022. But it's getting close to its normal multiple here. But again, you're taking a lot of risk to buy this for a rate of return that is not necessarily, exceptional. Looking at Kroger. Kroger's another very interesting one here. This is the grocery chain. They're going to be merging with Albertsons, or they're trying to. That's gotten the stock very inexpensive. Looking at it going, it does have an earnings yield of almost 10%, a dividend yield of 2.6. You can buy this at 10 times earnings. It normally trades at a discount of only 13 times earnings, but it's significantly below that. And let me make sure you understand what I'm showing you here. Even though this company is only forecast to grow at 2.86%, you stand to make almost 20% a year. So the question is how, and where does that 20% come from? Well, it would come from getting about 2.86% growth. It would come from getting another 2.5% of dividend income that's actually expected to increase every year. So that puts you above 5%. But then it's talking about the PE ratio expanding from, currently a 10 PE to a 14 PE. And if I look at the normal multiple of only a 12 PE, this could take you still to double-digit rates of return because you get growth, moderate growth, minimal growth. You get dividend yield, minimal growth of the dividend yield, but you get a couple of points of PE expansion. And I call that natural leverage. This stock does have a nice margin of safety. Now, you might want to take a closer look at Kroger. McCormick has been inexplicably trading at very, very high multiples recently. I want you to look at this graph carefully. The stock does grow nicely. It did have a negative year in 2022. The earnings were down 17%. The market likes to put a 20 plus multiple on this stock, but there are long periods of time where it traded much significantly below that. So you should be taking that into consideration. But look how volatile this stock has gotten when the valuations were high. In addition to the fact that you don't make any money buying it at a high valuation like this, you also face an enormous amount of volatility with what is theoretically a very, stable company. Because if I take price off of the graph, and even notwithstanding that one down year, this company has a very excellent long-term record, and it also has a very excellent long-term dividend growth record. But the problem is the valuation now has gotten so high that I believe you should look elsewhere. And I'm not even going to bother to go into forecasting. I think you can clearly see that the risk of investing in McCormick today doesn't really make any sense. Looking at Nestle, we get another picture of a premium valuation, very high level of risk here, in my opinion, for not much chance of a rate of return. It is AA rated, has less than 50% debt, offers a 2.37% dividend yield, earnings yield a meager 4.7%, and trades at over 21 times earnings. I don't consider that attractive at this level. Pepsi, very similar, trading at very high valuations the last several years. I just don't see any real future in these stocks. The normal multiple would, again, this is the high multiple it's traded at for the last 5 years. If I go to the normal multiple it's traded at long term, it drops down to about a 5.5% rate of return, which is positive. And I want to emphasize that. And I can't argue with the market. The market has always put this premium. It's A+ rated. It has, almost 59% debt to capital ratio. But the point is, it's trading at a very high valuation, even though the stock has corrected a little bit. Extremely high quality company. If you can get opportunities to buy it here, as I did, by the way, then you can, that'd be a great time to buy Pepsi. But I personally, for my money, don't like it. Procter & Gamble is the same story, trading at very high valuations. Look how volatile these stocks get when they trade at these high valuations. So, you're not looking at a great opportunity, even with the normal multiple that's been so high recently. You could make 8%, but if I go to this long-term normal multiple, which has only been 20 times earnings, which is still very high, you're down to making a 2.5% annualized rate of return. And again, I think you're taking extreme risk to do that, because there's always the opportunity, especially if another recession comes along, for this stock to drop down to a 15 multiple. And if it did, you'd stand to lose, 26% of your money. And this is what I call an obvious mistake. The beauty of fast graphs is it alerts you to this. Now, you can argue that, yes, the market does put a premium valuation, but you could also should be cognizant of the fact that that valuation is much higher than normal. S.J. Smucker and Company is one that's coming close to being reasonably valued. It's one of the faster growing of the group, forecast to grow at around 6% a year, giving you a decent 7% rate of return. If I use the normal multiple, which is slightly below 15, I get 6.5%. So this one is getting attractive at almost a 3% yield. But again, the best time to be buying a stock like this is when the price gets below the orange line. It's moving in that direction, so it's one that you might want to watch and follow. And then last but not least is the most interesting one of the group is Tyson. You can see Tyson had a great record. They've recently had this huge collapse in earnings. What's interesting about this company is the market expects its earnings to recover at a very high rate of over 146% going forward. So let me shorten this time frame so you see that clear. And then 35% after that. What's really happening is the market's expecting it to begin reverting back to its normal, earnings levels, earnings levels that it was able to achieve in all these years here, but it's still forecasting below those levels. But because the price has fallen so much, and because, the recovery is so powerful, expected, you could generate extremely high rates of return. But I do want to point out, you're looking at what I consider to be a speculative situation here. The current valuation is 30 times earnings with only a 3% earnings yield and a 3.68%. But it's the future earnings yield that you'd be looking at here with a company like Tyson. So, there you have it, the consumer staple stocks. Hope you enjoyed this video. These were requested by, you, the subscriber here to our channel. And so I thought I'd add a part 4 bonus kind of round, if you will, to the parts 1, 2, and 3 of this series, where I was covering the consumer staples. Part of my goal here is so you understand the nature of the beast, how the market treats them and what they're going at, and then how you can analyze those for your own benefit or iteration, whether or not you want to buy, sell, or hold any of these stocks. Hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to the channel if you haven't already, and take a look at Fast Graphs. What a great tool and a powerful way for you to analyze stocks deeper and faster than ever before. Thanks for watching. I'll talk to you again real soon.